Hi. Let's learn about equity in finance. Equity, also known as shareholders' equity or owner's equity for private companies, is the amount of money that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debt was paid off. It is found on a company's balance sheet and is used by analysts to assess a company's financial health. Shareholder equity represents the value of an investor's stake in a company and is used to provide an opportunity to share in the profits and growth of a firm. It can also give shareholders the right to vote on corporate actions and elections for the board of directors. It can be either negative or positive, with a positive shareholder equity indicating that the company has enough assets to cover its liabilities. Shareholder equity is not a definitive indicator of a company's financial health and should be used in conjunction with other tools and metrics for analysis. Shareholders' equity is calculated by subtracting the total liabilities from the total assets of a company, which can be found on the balance sheet. Shareholder equity can also be expressed as a company's share capital and retained earnings less the value of treasury shares. Retained earnings and treasury shares are components of shareholder equity. Retained earnings represent a cumulative total of profits that have been saved and put aside for future use, while treasury shares represent stock that the company has bought back from existing shareholders. An example of shareholder equity can be found on a company's balance sheet, such as ExxonMobil Corporation's, where assets equal liabilities plus shareholder equity. Equity has applications beyond evaluating companies, such as private equity, home equity, and brand equity. Private equity refers to the evaluation of companies that are not publicly traded, while home equity represents the value of homeownership. Brand equity measures the value of a brand relative to a generic or store brand version of a product. There are different types of private equity financing, such as venture capitalists, leveraged buyouts, and private investments in public companies. This type of financing is not accessible to the average individual, as it is usually meant for accredited investors. Return on equity is a measure of financial performance calculated by dividing net income by shareholder equity. It is a measure of how effectively management uses a company's assets to create profits. Equity in finance refers to different specific meanings depending on the context. The most common type of equity is shareholders' equity, which is calculated by taking a company's total assets and subtracting its total liabilities. Other terms used to describe equity include book value and net asset value, and they generally refer to the value of an investment that would be left over after paying off all of the liabilities associated with that investment. Equity is an important concept for investors, as they might use shareholders' equity as a benchmark for determining whether a particular purchase price is expensive. It is also used in analyzing a company's balance sheet for investment decisions. Equity is equal to total assets minus its total liabilities, which can be found on a company's balance sheet. For a homeowner, equity would be the value of the home less any outstanding mortgage debt or liens. Here are 3 key takeaways. 1. Equity is used by investors to assess a company's financial health and as a benchmark for determining purchase prices. 2. There are different types of equity, such as private equity, home equity, and brand equity, which have specific applications in finance and investing. 3. Return on equity, ROE, is a measure of financial performance calculated by dividing net income by shareholder equity. Hope this would help. Thanks for watching.